15 sections you need to include in your financial projection section of your business plan. Number 1, revenue forecast. Number 2, cost of goods sold. Number 3, gross profit analysis. Number 4, operating expenses. Number 5, net income projections. Number 6, cash flow projections. Number 7, break-even analysis. Number 8, balance sheet projections. Number 9, profit and loss statement. Number 10, key financial ratios. Number 11, capital expenditures or CapEx projections. Number 12, funding requirements or use of funds or use of proceeds. Number 13, assumptions. Number 14, scenario analysis, so best case, worst case scenarios. And number 15, financial summary and key takeaways. Those are 15 sections you need to include in the financial projections section of your business plan. And I'm going to go over them one by one. And I actually put together a list that I'll share the link with you guys in the description down low for the video. But I'm going to share this with you guys so you guys can see what I am seeing and we can go over it one by one. So let me share this with you guys. Okay, here is the list. If you guys see what I am seeing, you guys now see the sections you need to include in the financial projections section of your business plan. And I'm going to go over these one by one. And starting with the first one, which is revenue forecast. This is the simplest, right? This is going to be a detailed projection of your future revenue. And you want to break this down by product, service lines, or business segments. So when you're projecting out your financial projections in your business plan, right, what you want to do is break it down by, let's say you're a restaurant and it may be beverages, food, alcohol, right? It could be a service business like mine where it's business plans, pitch decks, websites, financial projections, right? 4 different things that I help my clients do. We can break that down. So revenue projections is the first thing you want to include in the financial projections section of your business plan. The next one is the cost of goods sold. So this is expected costs directly related to producing a good or service and a breakdown of variable and fixed costs. So for example, if you have a coffee that you're selling coffee, and the cost of each coffee is $1, and you're selling the cup of coffee for $3. So the cost may include the coffee, the cup, and the lid, right? That is your cost of goods sold. And you want to include and break down the variable cost and the fixed cost. So a variable cost is something that changes. A fixed cost is something that stays the same. So for example, a variable cost could be something that moves up and down depending on the amount of items that you sell. So for example, a variable cost, let's say on a business planning business, I write business plans for a living. A fixed cost may be my cost of internet. Every month is the same price, $59.99. A variable cost may be my printing cost, right? So depending on the size of the business plan, the more page count, my costs go up. It's variable, right? It varies depending on it. So on your cost of goods sold, another section you need to include in your financial projections section, make sure you're including everything directly related, and break down the variable and fixed costs. Another example of variable and fixed costs, right? So for example, if you're running a trucking company, fixed cost may be your insurance. Every single month is the same. A variable cost may be your gas, right? It changes depending on how much mileage. You want to break that down. The third thing to include in your financial projections section of the business plan is your gross profit analysis. Now, this is not the same thing as net income, which we'll go into later. And I actually put a video up, and I have the link at the end of this for the difference between a gross profit and net income. But to include in the financial projections section of your business plan, the gross profit analysis, you want to put together an analysis of your gross profit or gross margin percentages. And this is insight into the projected profitability trends of the company. And to give you a kind of foreshadowing of what this is, gross profit is your revenues minus your cost of goods sold. That's all it is, right? Whereas net income is going to be your revenues minus your cost of goods sold, and all of your other expenses. So number 3, gross profit analysis. Number 4, the fourth thing you should include in the financial projection section of a business plan is your operating expenses. So this includes everything from your salaries, your rent, your internet, your telephone bill, your what other expense, basically any other expenses you have not related to the actual product or service are going to go in your operating expenses. Again, make sure to separate the fixed from variable cost here. The fifth thing you should include in your financial projections section of your business plan is your net income projection. So this is what I was talking about before. Your net income is basically your revenue minus your cost of goods sold minus your operating expenses and taxes and all other costs. So this is everything. So think of it like net income is like a net. After everything is done, what's caught in the net is what you get to keep, right? After the rent gets taken, after the cost of goods gets taken, after marketing gets taken, after Uncle Sam gets his, whatever's left in that net is net income. And that's what you get to keep. And you want to put together a net income projection for your business plan. Now, why is this different? A lot of people don't understand why this is different. Well, when you have a cost of goods section, right, a cost of goods sold section and a net income projection section, you can determine how much is actually going to come into your pocket or how much is going to come into your investor's pocket or how much money you have left over to pay a potential loan. So that's why it's important to put together net income projections in your business plan, okay? Number 6 of things to include in your financial projections for your business plan is your cash flow projections. So cash flow is not revenue projections, right? Revenue can tell you how much you're making. Cash flow tells you how it's coming in and out of the business. And it breaks down monthly or quarterly or yearly, right? Your projected cash inflows and outflows. And this highlights operating, investing, and financing cash flows. So for example, you want to include the reason you want to include a cash flow projection is because you want to know when money comes in and when money goes out. If I say a business makes $120,000 a year and only spends $80,000 a year, you would say, well, then the business makes $40,000 a year. But that business can go belly up in month 4 if you didn't project when that money comes in. So if the majority of that money comes in month 12, but the majority of the money going out is going out in month 4, you need to account for that and finance your business accordingly. So cash flow projections are super important. They're one of the key financial statements or the 4 financial statements that you need to include in a financial projections section, and that's number 6. Number 7 for things to include in a financial projections section of a business plan is the break-even analysis. Okay, so this is if you're starting a business or if you're expanding a business, this calculates the break-even point or the units or revenue needed to cover the cost. And usually in this section, you want to include visual charts or graphs for better comparison. So basically, it shows you when or how many units I need to sell to get all my money back, right? To break even. So a break-even analysis should be included in every section, financial projections section of a business plan. The 8th section to include in the financial projections section of a business plan is the balance sheet section. This forecast, your balance sheet is another key financial statement, along with the cash flow statement, that forecasts your assets, liabilities, equity for a projected period. Usually they're year over year or month over month comparisons, okay? So balance sheet is usually assets equals liability plus stockholders' equity. That's the formula. I won't get too in-depth into this. I have another video that talks about balance sheets, but this needs to be included in the financial projections section of your business plan. And the reason is you want to know how much assets you have. You want to know how much your total liabilities are. And once you subtract your assets from your liabilities, you're going to get how much you own in the business, right? So if you have more assets than liabilities, you have positive equity. If you have more liabilities than assets, you have negative equity in the business, right? And this can be included, by the way, for your personal financial statement. Number 9. Things to include in the financial projection section of a business plan, your profit and loss statement. This is a projected income statement showing revenues, cost of goods sold, gross profit, expenses, and net income, okay? This is for periodic comparisons for monthly, quarterly, or annually. This can be derived from your cash flow statement. But basically it shows, are you profitable or are you losing money? Okay, that's your profit and loss statement. Number 10, things to include financial projection section of a business plan is your key financial ratios. So this can include things like return on investment, debt to equity ratio, percentage of sales to marketing. Any ratio that you think can measure the health of your business should be included in this. And there's a whole string of key financial ratios that you can put together. You can go as in depth as 30 different financial ratios, 100 different financial ratios. I would include the basics, your current ratio, your debt to equity ratio, and your return on investment ratio, and maybe your profit margin, right? That's a key ratio that you want to include. Number 11 on things to include in a financial projection section of a business plan is capital expenditures, or what they call CapEx projections. These are anticipated spending on major assets or infrastructure, and this is a long-term investment outlook. So a CapEx expenditure could be the purchase of a new building, right? Or the addition onto an existing building. This is something that's usually going to go onto your balance sheet as a major asset, right? And you want to include these in there because they will affect your balance sheet, which will in turn affect whether you have equity in the business or not. So if you make a major CapEx expenditure, you take out $1 million loan, you spend $500,000 on working capital, but $500,000 on a building. Well, that $500,000 is going to stay on the balance sheet, right? That other $500,000 for working capital may get spent in marketing. It's going to go out the door. It's not going to show up on your balance sheet just yet. It might come back as cash, right? It might come back as revenue, which will end up as cash. But for now, it will show up as a capital expenditure, and it will show up on your balance sheet. So it's important to put that in a different section so investors can see, hey, if I'm investing this much money, this much is going to CapEx. The actual asset will increase in value. Number 12 on things to include in the financial projections section of the business plan is your funding requirements or use of proceeds. This is one of the key elements of any financial projection section of a business plan. This is when the investor says, hey, what are you spending the money on? Hey, how are you going to use my money, right? This is this section. And sometimes it's called use of proceeds, use of funds, funding requirements, money spent, capital funds, capital use of proceeds. It has a lot of different names, but basically you're going to outline how you're going to use the expansion or investment capital or startup capital in the business. So if you're starting a restaurant, it could be the first 3 months of rent. It could be equipment. It could be inventory, right? If you're starting a landscaping company, it could be, the lawnmowers, the seeds, marketing collateral, any way you're going to spend the money. If I give you $100,000 and I ask you, how are you going to spend it to start this business? This is what you're going to break down. And the best way to do this is really a pie graph. If you put together a pie graph and a list, you should be able to break down visually how you're going to use the investment money or the loan that you're using to start your business or the investment that you're using to start your business. But this is a key area for any business plan in general, but definitely for the financial projection section of the business plan. You really want to break down exactly how you're going to use every single dollar that you start the business with. Number 13 on things to include in the financial projections section of the business plan is your assumptions. So your assumptions are what you're assuming based on your financial projections. So for example, if you project out, we're going to make $1 million. Well, why? Why are you going to make that? Well, we think that there's, we know, first of all, you're always going to base your assumptions on something that's data driven. Okay. So your assumptions are based on something that's data driven. So for example, if you're opening up a restaurant, I'll keep using that example to stay in unison with what we've been talking about. And you're opening up a restaurant in X village in New York, right? Well, how many people are in that village, right? That's a key assumption. So go to the Census Bureau. There's 100,000 people in that village. Okay, we're assuming that we're going to get 10% of those people to come to our restaurant every single month, right? You see how the assumption is based on something factual. So if you're starting a landscaping company and there's 100,000 people in the village, but there's only 50,000 homes, and you say, we assume we're going to cut 100,000 yards. Well, there's only 50,000 homes, right? That's not even, that your basis of assumption was wrong. So you want to include your assumptions and base all of your assumptions on factual data, and then derive an assumption off of that factual data. So Key assumptions could include market growth rate, your pricing strategy, your cost trends, et cetera. Again, remember, some of these things are based on real data, right? So, for example, your cost trends, you should know what it costs if you're starting a cafe, how much your coffee is going to cost or how much you're going to buy it for. That's going to be an assumption. Hey, we're assuming because you haven't done it yet, right? We're assuming we're going to buy the coffee at 50 cents, 25 cents, 10 cents, and we're going to sell it for $3. Those are your assumptions. Now, you're not pulling these assumptions out of thin air, right? You're going to go and look at what other coffee shops are charging for coffee. You're going to go and look at what suppliers are charging for coffee, so you know what you're buying it at. And based on that, you're going to create reasonable assumptions based off of that data. So make sure in your financial projection section of your business plan, you're including assumptions, but those assumptions are based on some facts. And then off of those facts, you're deriving key assumptions to your business. Number 14 of things to include in your financial projections section of your business plan is your scenario analysis. So a lot of people get really tied up in this. This is best case, worst case, and most likely financial scenarios, right? And this can also include a sensitivity analysis to assess the risk and adaptability. Now, people are like, I have 100,000 homes in the village. I'm going to start a landscaping company. Best case scenario, I get all of the homes. Well, Bob has his own lawnmower. You're not going to get all of the homes, right? And Mary, doesn't have a yard, right? Doesn't have any grass. She put gravel over it, so you're not going to get that home. So in the best case scenarios, you still have to be reasonable. And in the worst case scenarios, you still have to be reasonable. Now, some cases, people say the worst case scenario is zero, right? I die tomorrow and nothing happens, which is probably the most honest worst case scenario. But that's not really what this practice is about. In the financial projections section of the business plan, when you put together a scenario analysis, best case, worst case, and most likely, all you're doing is telling the reader or the investor or the potential bank that's giving you a loan, hey, look, we've thought this out, and best case scenario, our marketing dollars will convert this much traffic in. Worst case scenario, our marketing dollars don't work. There's black swan events or something that happened that is outside of our control that makes it to the worst case scenario. And then the most likely scenario is this, right? So this just gives people a range of what the scenario could be on your financial projections. Don't get so tied up in this that you get stuck in analysis paralysis because you can come up with a million different scenarios. But really, it's high estimate, super low estimate, middle estimate, right? And you're being reasonable in the middle. And the final section that every financial projections section of a business plan should include is your financial summary and key takeaways. So this is basically a summary of everything I just talked about, the other 14 sections of the financial projections section. And it includes a high-level overview summarizing all the critical points of the financial projection. And hopefully here, you put together a visual representation like pie graphs and bar charts with key data points, including, what are our costs every month or every year? What are our profit margins every year? What are our revenues every year? And that way the reader can get a quick glimpse, right? If he doesn't read through the rest of the financial projection section, he can go straight to this section and get a quick glimpse of everything that you did in the financial statements, including what's in the profit and loss statement, what's in the balance sheet statement, what is in the cash flow statement. All of these things should be summarized in the financial projections and key takeaways. So those are the 15 things that you should include in the financial projections section of a business plan. Just to recap, revenue forecast should be included, cost of goods sold, gross profit analysis, operating expenses, net income projections, cash flow projections, break-even analysis, your balance sheet, your pro forma profit and loss statement. By the way, side note, pro forma just means in the future or projected. Your key financial ratios, capital expenditures or CapEx projections, funding requirements and use of proceeds or use of funds, assumptions, scenarios, analysis, and the financial summary and key takeaways. I'm going to put a link to this whole document At the bottom of my YouTube video, if you ever need help writing a business plan, I'm here to help. I graduated business school, law school. I'm an entrepreneur. I own a ton of businesses, and I write business plans full time. So I help my clients develop strategic business plans to expand their business or acquire a new business. I hope this was helpful. If it was, subscribe to the channel, hit that like button, and I'll catch you guys on the next video.